The economy may be putting up good growth and the stock market responding in kind, but there are a few storms beginning to take shape on the horizon, says our next guest. Mark Zandi is the chief economist at Moody's Analytics. Mark, always nice to get some time with you. What are some of the storms that you're talking about here? And do you think next year is the year that markets will finally start to take notice of our country's fiscal situation?
Yeah, I'm obviously focused on the possibility of broad-based tariffs and deportations. Both those policy moves would exacerbate inflationary pressures, put upward pressure on interest rates, and diminish economic growth. They're what economists would call a negative supply shock. Now, obviously, a lot depends on what those policies are and how they're implemented and over what period of time, but those are the storm clouds that I'm most focused on for next year in 2025.
Mark, you mentioned the immigration or what may happen there on that front from incoming President Trump. Take us through what is the ripple effect? If you deport those many people, what's the impact to the labor market? What's the impact to corporations? And what's the impact to the economy?
Well, it goes to labor supply. We are in a full employment economy. The unemployment rate is 4%. It's been there for couple, 3 years. The labor market's been tight. A lot of the folks that have been coming into the labor force are immigrants. If we have significant deportations, and it would be actual deportations, maybe even self-deportation. We're seeing, for example, businesses become much more reticent in hiring immigrants for fear that they might be deported in the future. That reduces the supply of labor, makes the labor market even tighter, creates wage pressures, price pressures, and makes it much more difficult for the economy to grow. And this is really key for lots of important industries. Obviously the agricultural industry, which goes to the price of groceries. It goes to the employment in the construction trades, home building, which goes to rents and the cost of housing. Childcare, elder care, leisure hospitality, retail. These are all sectors that depend very heavily on immigrants. So if you see significant deportations and restrictions on that labor supply, it'll diminish growth and cause inflation to rise.
What does that mean then for the stickiest component of inflation, which has been shelter costs?
Yeah, it would put pressure on rents, and rents ultimately drive the cost of housing. We have a very severe shortage of affordable housing, and we need to build a lot more homes. And actually, no sector of the economy is more dependent on immigrants than the construction trades. About 30% of all the workers in construction are immigrants. And that's nationwide. If you go into parts of the South and West, you'll see immigrant shares that are closer to 40, 50%. So, if you see a lot of deportations and the construction trades can't build, we see fewer homes being put up. That adds to rents and prices and adds to the cost of housing.
Mark, I would love to know what you make of some of the pull forward in spending that businesses have been doing in order to get ahead of any potential tariffs that might impact their operations and their ability to source. How will that have a perhaps unintended impact, even if we don't see tariffs come forward, because now you've seen some of that capital be allocated earlier than anticipated?
Yeah, I haven't seen that. I mean, I've heard the anecdotes, no doubt about it. I just haven't seen it in the data. Now, it may be just a bit premature. The data is a bit lagged. The trade data only goes through October. The other data on investment and purchasing managers and spending only goes through November. So I would expect the pull forward effects that you talked about to start showing up this month in December and in January. So maybe a little early. But so far in the data, I really haven't seen it. I mean, we have seen strong Christmas sales, and that would be consistent with the idea of pull forward. The consumers, for example, are buying things a little earlier than they normally would, just because they're fearful of the higher tariffs and the impact on prices. But I'm stretching. So far at least, I have not seen that to any significant degree, at least in the data that I look at.
And Mark, going back to what we were just talking about, the country's fiscal position, of course, our ballooning debt position, which increases by the seconds. Doesn't it seem like it's time to address Social Security? And how would the government or the Trump administration even go about doing that?
I'm sorry, to do what?
Social Security. It seems like that is ripe for some form of reform.
Yeah, well, this goes to our broader budgetary problems. I mean, we have large, obviously, deficits, 6% of GDP, and that's a full employment economy. And funding Social Security is just part of that. There's only two ways of addressing this, or I guess three ways. One is we could grow our way out if we grow more strongly, but of course that goes back to policies like tariffs and immigration. And certainly there's no better way to grow the economy more quickly than rational immigration into the country, immigration reform. So that's one way. That would be the most desirable way. The other way is to raise taxes, and we're not talking about that here going forward. We're talking about more tax cuts, not tax increases. There's that would be a way. And the third is spending restraint, cutting spending, but that's pretty tough to do politically. And actually, when you get down to brass tacks, most of the expenditures are on things like Social Security, Medicare, and Medicaid, which are entitlements and very difficult to address. So there's no obvious way, no simple way, no smoking gun way of addressing the Social Security problem.
Mark, just lastly, while we have you here, as the markets were reacting to the Fed's pivot slightly, at least in tenor, and what the anticipations were for 2025 and future cuts, it seemed like the markets were rattled by that, and everyone trying to gauge what the Fed's mood ring might look like going into 2025. What are your top anticipations of the Fed going into next year?
I think they're going to sit on their hands. Going back to the tariffs and the deportations, that means higher inflation and weaker growth. So you're sitting at the Fed. What do you do with that? Do you respond to the higher inflation by raising rates or not cutting rates, or do you respond to the weaker growth by cutting rates more quickly? It's not unclear. It really does depend on the policies. The tariffs. How high are the tariffs going to go on which countries over what period of time? How much damage is it going to do? So with that uncertainty, which is going to be at a very heightened level, I think the Federal Reserve just says, I'm not moving. I'm just sitting where I am. And it's okay because they have cut rates a full percentage point from where they were back last fall. And, the federal funds rate target is pretty close to what you might consider to be the equilibrium rate, that rate at which policies either supporting or restraining economic growth. So it's okay. But I suspect we're not going to see any moves by the Fed for most of next year, certainly not in the first half of next year.
Mark, great to see you. Get a Capriati's cheesesteak for me if you can. Appreciate it.
Anytime. Take care.
Thanks.